Let's see what our next guest thinks. David Zervos is the chief market strategist at Jefferies. So, Dave, you might think all of this is unnecessary, and markets just kind of have to shake themselves out of it. And do you think the events of this week are significant in terms of the falling dollar, rising bond yields, and so forth, or no?
I think they're very significant, Kelly. I mean, this is a highly unusual risk-off period where the dollar weakens and bond yields rise, or at least don't move significantly. They obviously moved a lot lower and then came almost all the way back. So they didn't offset equities like they usually do. But the weaker dollar is a really different phenomenon. In most of the crises where these types of funding facilities would come in that Steve was just talking about, they're almost always in an environment where people are running for the safety of the dollar. And you know what? This is maybe worth thinking about. The only other one that we've seen was in October of 22 with the LDI crisis with the UK, where we've seen the long end have some issues like it's having, largely because the marginal buyer is a leveraged buyer, and there's risks of trade battle-related selling from our trading partners. So I think the facilities aren't 100% set up exactly in the past for a weaker dollar risk-off scenario, which is probably confusing the markets a little and maybe even confusing the Fed and Treasury.
So, David, that's really interesting because I had this weird thought this morning. The swap lines are to borrow dollars when dollars are short.
Absolutely.
And I tried to run through my brain, could the Fed borrow euros? I mean, they are, by the way, bidirectional.
They
like can go both ways.
We made the LNG export terminals. Or the import terminals. We had to flip around and make them export terminals.
It's same idea. I don't know, David.
So I don't think that's. I don't think that would be the way I would think about it. I think the way I would think about it is the currency policy is probably largely going to be set by the administration and the Treasury Department. That's not the Fed's lane. And really, Steve, what I think we're seeing, and what I've been arguing with, speaking to our clients about this past week, is there is a cogent effort to kind of take down the mercantilist trading structures that have been in place for many decades. That's what this last week was about. And part of that involves likely a weakening of the dollar. So I don't know that you want to be changing that. You want to do that in a way that doesn't completely disrupt the bond market or trading partners who have amassed large amounts of dollar securities, which is a difficult needle to thread, no doubt. I don't think we're 100% in that heat of the battle in the trade war where it gets there, but we should have the facilities there to make sure that something like that doesn't happen. And I imagine that has been discussed because it did happen in the UK.
David, I want to establish a couple facts on the ground as you may or may not know them. Is there a shortage of quality collateral? That's the kind of thing that's caused market disruptions before. Is there a dollar shortage? My read is both no, but do you have any inkling at all? Because that changes the game if that's the case.
I don't believe that's the story. There may be desires to raise money and sell, but I really think what we're seeing, Steve, is much more of a reallocation away from U.S. dollar assets as the trading landscape is changed. And the trading landscape is that we're going into a kind of battle a la what we did in 1985 with the Plaza Accord to say, hey, this is imbalanced. We have huge trade imbalances with Western Europe and with Japan. This time it's with China. And part of that involves changing the way the currency is manipulated by our trading partners.
I don't know if this is hyperbole or not, but somebody described this to me as equivalent to Nixon coming off the gold standard.